Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I'm delighted again to be able to speak to Paul Scott of Stockopedia, one of the UK's finest small and micro cap investors. So, welcome, Paul.
Thanks, Paul, and hi to everyone. Great to be back.
Yeah, well, big congrats on your year-to-date portfolio performance, which I think is sort of like 30% plus year-to-date versus AIM down sort of 10%. Indeed, I think you've had a pretty good last 15 years since the financial crisis. So just broadly for investors, what's sort of the magic formula, the Scotty secret sauce behind the sort of stock picking success over the last sort of 15 years? What are the key traits?
Well, I think that's a bit of an edited highlights version of my career, actually, Paul. I've had some absolute disasters along the way, but the main mistakes I've made were all concerning gearing. So I've just decided now, I've had fabulous returns from geared accounts for years, but then you'll just hit a bear market and everything just gets totally screwed up. So that side of things was a total roller coaster ride, but I've stopped gearing altogether now. So my ungeared portfolio is relatively small compared with the money I had last year when I lost nearly all the money in the spread betting accounts. I
Well,
know I
I'm
shouldn't
glad
be
you gave
laughing.
that up.
I shouldn't be laughing, but it's the best way to just draw a line under it and move on, isn't it?
Yeah, it is. Yeah.
Things go wrong in all our lives.
Yeah.
So I don't think there's really any secret sauce. I mean, I redid my numbers this morning since I took over running a SIP myself, which was in 2012. And actually, this is a really good tip for people. If you've got lots of little pensions lying around that are just dormant from previous jobs, consolidate them into a SIP, and which is what I did. And I was really surprised at how much money was there when I did this in 2012, and it was money I'd forgotten I had.
Mm.
So that was a good start. And since then, since 2012, the money I had in the SIP, I've six bagged it,
Wow.
which works out at, with no extra money going in, that was just a frozen portfolio. It's six bagged in 10 years, and that works out at a compound annual gain of 17%, which I think was up from 14% last time we spoke, because I've had
Yeah.
a
Yeah.
really strong year this year, but a terrible year last year when it went down. So I think if you can compound at anything in the teens or above, you're going to make serious money long term. I mean, I put the numbers into a spreadsheet. It's staggering how these amounts compound, over 10,
Yeah.
15, 20 years.
No, I
So
would
I think
agree.
there's no need to use gearing. You can just by being more sensible and trying to out. And I think 20% per annum in small caps is doable. I know plenty of people who, well, not plenty, but a few dozen people I know have achieved that sort of 20%-ish gain compound year in, year out. Well, they'll have the odd year where they make 100%, and the odd year where they make minus 20. But if you can, so I think there's great money to be made in small caps, longer term.
And what's the sort of the sweet spot? Is it looking at sort of value plays, or is it looking for GARP stocks, got growth stocks, or a bit of
Uh,
everything?
I don't know. It's difficult to say, isn't it? The market goes through different patches where
Mm,
different strategies perform differently. I mean, I tend to just boil it down to the individual company level. I think in good markets or bad, there will always be some companies putting out really strong results and outlooks who buck the trend.
mm.
Um, I mean, obviously, it's a smaller percentage of stocks that are doing that right now. But one of the readers on Stockopedia put up a couple of lists of, shares that have done very well over the last 12 months, and there are plenty of them.
Mm.
So yeah, for me, I'm just a stock picker. I look at the individual shares and I try and find stuff that's relatively small, where nobody's really looking.
Mm.
There's not any broker coverage, where they'll particularly in bear markets at the moment, they'll put out positive trading updates with a nice strong outlook. You compare it with the last one and you can see a change in tone. Big substantial director buying, I think, can often be a good signal. So I'm really looking for individual stocks that I think will outperform in any market.
Mm. What about this sort of the importance of sort of resilience in down markets? Because I mean, just broadly, sort of the hit rate, if you go into smaller micro caps, anything more than 60%, you're doing pretty well, actually. That's industry leading, particularly if you've got sort of like a few big winners along the way, which tends to be the case to sort of counteract the losers. So if that's a sort of like the hit rate, sort of like you're wrong a third of the time at least,
at
then
least. Yeah.
you're going to have to go through some pretty tough periods. And so resilient, how important do you think resilience is when you go through these sort of bear markets?
Well, actually, I've learnt, I think, quite a bit in the last year or two from my mistakes. And whereas I always used to just stubbornly stick with things, once I'd done my research, I would say the market's wrong, I'm right, and I would,
I've been
and
there.
yeah, and it doesn't. Quite often it doesn't end well.
No.
So what I've decided to do now is just be a bit more ruthless with positions. I'm trying not to form sort of quite extreme or strident views on stocks. I'm trying to look at both sides. We're continuously learning, aren't we, Paul? All of us. I
Mm,
mean, we've been doing this, as you say, 25, 30 years
yeah.
each, and you learn every day. That's why it's so fascinating. So,
Mm,
yeah, I'm definitely being less stubborn, less dogmatic about stock picks. And I'm looking at my portfolio, and when I want to buy something, like my current biggest holding that we'll talk about in a minute, I'm having to look at all the other positions and say, well, something's got to go, and I've been quite ruthless in just chopping out things that where I've just been stubborn and got it wrong so far.
yeah. Good. Okay. And then just in terms of sort of broadly for small and micro caps, we've had a really bad period of sort of like, underperformance from AIM. I think it's down over 40% since its peak in
It
2021.
is. Yeah,
So
we've
it's
had a
been,
two-year bear market down 43% from August 2021, which I'm staggered at. I mean, I didn't
yeah.
think it would be. And the interesting thing is I can't remember a time when the AIM market and the small caps generally were such an outlier. Normally when you look at
Mm,
the bear markets, the FTSE halves, doesn't it? Like it did in 2001, 2002. The FTSE and the Dow, all those things crashed in 2008, and take small caps with them. But this time around, actually, the bigger indices, America and over here, and in Germany and elsewhere, seem to be holding up really well. But the small caps have absolutely plummeted. Well, that gap to me is my opportunity.
mm. Mean
You know,
reversion.
Yes, mean
Yeah.
reversion. I mean, okay, you look at 2021, there was lots of stuff we all got a bit overexcited about, wasn't there, with
Yes.
hindsight? And I think you've got the structural problem at the moment where a lot of these small cap funds are facing big redemptions, and
Mm,
you can't blame the fund holders who look at how badly they've performed and want their money out. And of course, there's no liquidity. They
yeah.
can't sell a lot of these positions, so you could have overhangs, I think, in some small cap
Mm,
shares for a year or more,
yeah.
possibly.
Yeah. I
But
have the
again,
same.
that it's throwing bargains at us, so we can take our pick. We can be highly selective, and this is where I think you and I and the listeners, we lay the groundwork for big gains once
Mm,
this market turns, which it always does. We've seen quite a few cycles over the years, and it always does turn. And 2 years into a nasty bear market, you're definitely nearer the end than you are the beginning, aren't you,
yeah.
of the bear market?
Oh, so when do you think the tide will turn on the on sort of AIM and small caps then? Any sort is
Well,
it early next year?
I think it might be starting to happen already selectively. I'm starting to see some sort of little green shoots of decent companies that are really bombed out in valuation, that are warning on profits again, and they spike down 20%, but then they kind of recover some or all of the way within days. I mean, a good recent example of that was Enna Aqua, which I think you're quite
Yeah.
familiar with. Um, the Headlam, the carpets distributor, a similar sort of thing, absolutely crashed on a profit warning, but buyers came in and they've held it. So
Mm.
things like that are starting. Plus, of course, all these takeover bids. We
Yeah.
had another one this morning, didn't we? For
Ergomed.
Ergomed, yeah,
Yeah.
yeah, Permira private equity. So the private equity guys are happy to pay quite full valuations
Mm.
for structural growth companies, I think, aren't they?
Yeah.
So I'm looking a bit more at that area as well. I'm naturally drawn towards value, but I think actually, if you see structural growth, the companies consistently doing well. I mean, Ergomed was a 10 bagger from 2019 to 2021.
Wow.
So yeah, amazing. Unfortunately I didn't pick up on that one. I don't know how it slipped through the net, but you can't pick up on everything, can you?
No, you've had a pretty good year, so you don't want to get too greedy. That's why
Well, I
you,
don't want to sound like I'm crowing just over having, seven
no,
or
you're
eight
not doing that. No, no,
good
no. I mean,
months after a disastrous 2022. So I deserve a little bit of luck, I think.
yeah, well, I mean and I think that's an important trait, isn't it? It's sort of like you're not as good as your finest hour, and you're not as bad as the darkest moment. I think that's key
Yes.
for investors. You need some sort of emotional stability to take you through the good times and the bad times, because you can get a bit over your skis when everything's going well. But let's be clear about it: a third of my selections, at least, go south, and therefore you're wrong a lot of the time, and you've got to then be able to get through the down times, as well as the sort of like you don't have a Christmas every time you make a winner.
Yeah, I think those are very wise words, Paul. I agree with all of that. I think one of the things I've noticed from the reader comments on the daily reports I write on Stockopedia is that a lot of especially the newer subscribers are so despondent and are so
Mm,
down, and they're really feeling quite serious emotional pain from the losses. And I do think sharing people's troubles with other investors on forums where people are going to be constructive and helpful is actually very valuable. And a bit of
mm,
we're all in this together. We've all
yeah.
suffered substantial losses over the last couple of years, is quite helpful.
Yeah, I mean,
Trouble shared and all that.
yeah, no, no, I totally agree. I mean, I've got similar sort of long-term returns as yourself, sort of like mid-teens, which I'm delighted with over sort of 25, 30 years. However, I've had large drawdowns, and the
Yeah.
latest one was obviously, the pandemic. And, like everybody else, I lost, well, not when I lost seven figures
Mm,
in a month,
yeah.
so, but that's not dissimilar to a lot of other people, because, in percentage terms, everybody got absolutely stuffed at the start of 20, because I was enlightened in value. So, but you have to get
Mm,
through it, and it's a matter of looking where you currently are, sifting through your portfolio, which one are your strongest you want to keep. If you need, making sure that there's anything there you want to eject and get rid of because you don't think it's going to get over the valley, and then free up some money and concentrate on where the bargains are. If that's
mm,
baby in the bathwater stuff, which I think you're brilliant at, because that's exactly what you did last year after a bad year. You got through the dark moment, and then have come out this side 12 months on, and everything's turned quite quickly. And hopefully, for people who have similarly suffered over the last 2 years, next year could be their banner year.
Yes, no, all very sensible stuff, Paul, definitely. And I think the other thing I found when you've had a really, really dire year, as I did last year, mainly because of the gearing, but also because everything was dropping, I think there's a lot to be said for just wiping the slate clean,
Mm.
and chucking everything out that's causing me anxiety. If I'm
As long as it
particularly if
isn't
I'm
everything.
yeah, but no, I mean, particularly say over the balance sheet.
Yeah.
I just decided I didn't want any more 70, 80, 90% falls on anything. So I just selected some fresh ideas of new stocks that were obviously oversold, and I made sure I was buying stuff with bulletproof balance sheets. Maybe get some divvies as well. And I think you can rebuild, and it'll take time. The one thing that so many investors lack, and I think the thing we all need to learn from really, is just to be more patient.
Mm.
This is a long-term game. We're trying to build up pots for our retirement in 20, 30, 40 years' time, or whatever it is. And you don't need to make spectacular percentage gains each year. Just if you're even doing sort of 7, 8, 9% per annum, you compound that, and it'll deliver a really good result. So I think this is why it's so important for youngsters. People just starting out in their working career, saving 1,000 or two a year into a pension scheme. They'll be really glad they've done that
Mm.
later in life.
Yeah, no, I would agree. Very wise words. Sort of like patience equals profits, doesn't it?
Yeah.
They're seamless. They're both sides of the equal sign. Now let's shoot to one of your latest investment that you explained, I think, on your podcast on Saturday, Plexus. And
Yes.
in fact, I think you pushed the share price up this morning, actually, Paul. So well done.
Possibly. Well, I mean, I've been buying this since I think it was on the 21st of August. It came out with a
Mm,
very, very interesting RNS, Plexus Holdings, absolute nano cap. I mean, the market cap, there's about 100 million shares in issue. It was about 4p. And I just read the last, the last 5 or 6 trading updates and contract win announcements. It doesn't take long, there's not many of them there, but they're full of little nuggets
mm,
of really quite promising sounding stuff, like a record contract win of £5 million was announced in March. Then in June, I think it was, they announced that contract had gone up to 8 million. That's the biggest ever contract the company's ever
They
had.
do
It's a
they do sort of like, wellhead, sort of like it's basically largely for gas to stop methane leaking from oil and gas
Yeah,
wells, don't they?
yeah, it's high-end
Mm,
wellheads for the oil and gas extraction industry. They've been quite widely used in the North Sea, I believe, and Plexus was profitable, and I think it had a market cap of around about 200 million
mm.
pounds back in 2015. It was making 5 million a year profit, has patented IP. Um, then it all started to go wrong in 2015, and basically there was just a drought of drilling for oil and gas as this whole ESG business took hold, and the whole industry now is under resourced, and we're now coming into a cyclical upturn. This is why lots of oil services companies are reporting, much stronger outlooks. So I think this is a good sector play generally. And Plexus, I think, was ridiculously oversold. It's 59% owned by management, who are the founders. The CEO's been there for 37 years, I think, or something. Totally passionate about the company. He's propped it up personally with 2.5 million in cash injected into the business in a convertible loan and buying a long leasehold property because he believes in it. And he could have taken it private for peanuts a year ago, but he seems very committed to the listing and to the company generally. And it's landed this major contract win, which Senkos says will actually make it profitable in the current financial year. It's been running about 4 million a year losses for the last 7 years. Now, amazingly, they got through that without actually any dilution. So the CEO really jealously guards the share count, as founder managers often do. And as I say, we can't be sure at the moment. It was one contract doesn't make doesn't make a boom, does it? But
No.
certainly the signs are there when you put it together with, for example, a big deal it's got with Schlumberger
Schlumberger, yeah.
on licensing. Yeah, and they've just renewed it for another 6 years, and basically a 3-year non-compete agreement with Technip expired, and Schlumberger has been developing the next generation of Plexus wellheads, which I believe, are going to be launched quite soon. And Schlumberger, what, 100 billion oil
No, I
services
mean,
giant.
yeah,
If
I
they're
know. Yeah, I mean, basically, Schlumberger and well known in the oil and gas services industry as being the technical leader, as in, like,
oh, that's interesting.
yeah,
Yeah.
by a mile more than Halliburton and all the other
Mm.
guys. They've got the best technology. 50% of their business is all tech. Now, the sort of key question for investors on Plexus is, obviously it's the technology, and the patented technology has been around for at least 10 years or so.
Oh, yeah,
And
more than that.
and
Yeah.
what sort of like triggered this sort of inflection point of sort of like the upswing? And likewise, how leading edge is the technology still compared to sort of the competition?
I'm not a sector expert, Paul, so I'm going to,
Mm,
admit my own limitations on this. But um, so I look for sort of external signals that tell me this is good. So really, the key one is that Schlumberger have
yeah.
licensed it, and have then extended that license from 3 years for another 6 years to 2029, and are funding and developing a whole range of products using Plexus's IP, which tells you that the IP is good, is tight,
Mm.
is patented. There's a new family of patents that Plexus are about to file, which they say will give them another 20 years of what they're doing. They've got quite a big in-house R&D team, so they're continuously refining and developing it within Plexus. So I just think, this we got that validation that this tech is
Yeah.
good, and Plexus should receive. I've seen figures of between 3 and 6% royalties from Schlumberger, and I believe the wellheads are kind of £1 million or $1 million a pop.
Yeah.
So they'll be selling globally. So the big unknown at the moment is what the royalty stream will be for Plexus, and I wouldn't even begin to want to guess at that. It's just an unknown. It's a known unknown.
Yeah. Yeah.
But when I was buying Plexus's market cap, when I started buying at 5p a share, the market cap was 5 million. And it's risen now to 12p a share, and it's still only 12 million market cap.
Yeah.
And it peaked at
So
over 200 million.
You've already one bagged or two bagged on it, so it's
Well,
not
one
too
bagged, yeah. But I
one
mean, I'm
bagged,
not
yeah.
I'm not in it for 10 or 12p.
No, no.
I think if this works, it's 50p to a quid.
Yeah.
But there's no guarantee. I
Yeah.
can't say that's definitely going to happen. I don't know. My time machine is in for servicing. I can't visit the future, unfortunately.
Yeah. Well,
But I
anyway,
just
it's up 28% today. So
yeah. I mean, it's the only thing that bothered me. I mean, I've bought quite a big chunk of these. I had to break it down into about 30 or 40 individual transactions. So I was just nibbling at it.
yeah.
And stocks coming from somewhere. I don't know who's selling. I haven't seen any RNSs. But with management owning 59%, that means the free float, everybody else is only about 4 million quid. And the trades are just steaming through constantly. I've stopped buying now because I ran out of money. So I think I stopped buying at about 9.5p, just literally because I've put everything into it that isn't in my other core positions. And I just hope to God it works. But I am a risk taker. I will take a calculated risk. This may well be too illiquid and too risky for lots of your listeners. So it never these are not recommendations. We're just flagging up ideas for people to research.
Yeah. Well, that's one of the things, isn't it? The beauties of what you do and what I do. It's a lot of idiosyncratic risk that we don't go for this sort of like, broad brush index style portfolio. We go for ones we specifically have high conviction plays. And clearly I'll have a good look at Plexus myself. Now, moving to the
so Paul, just on concentration. So you're normally quite concentrated, aren't you? So where do you stand on that at the moment?
I think I'll have to check, but I think I own about 12 or 13 stocks, a couple of big ones. I've got about 21% cash at the moment, which I'm looking to deploy into stocks and shares. I typically, I'll hold for 5 years, 6 years, 10 years, whatever it is. Sometimes you don't get a chance because it's sort of like it's either might be taken over or alternatively your thesis doesn't run through. But I'm prepared to hold thick and thin, as in like, until the investment thesis is broken, then I typically retain it in my portfolio. What about you? What about you? How many stocks do you own?
But it's pretty similar, actually, about 12 to 15. I'm concentrating heavily when I find something that I think is a real, when risk reward I think is really favorable. I tend to put 30, 40, even 50% of my money into one stock. Which
how much have you put into Plexus so far?
10%,
10% plus.
I'd rather not say, but it's a lot more than 10%.
Okay, well, you'll be disclosing your 3% position probably soon then.
Well, I'm over 2%.
Oh, okay, right. Okay, well, that gives us a good idea anyway.
Yeah, so it's really, but also I think you've got to plan for the downside, haven't you? So if something calamitous happened with Plexus, I've worked out the numbers so that it wouldn't kill me. It would be a disaster, but the remaining portfolio would be okay. I think a lot of people say, I was talking to a reader the other day who was saying he was averaging down on something. And he says, I've worked out my break-even price. And it was some absolute pile of junk. And I said to him, you shouldn't be trying to work out your average, your break-even price. You should be working out what your loss would be if it goes to zero. That's the key number, isn't it, to have in your head?
Yeah. I mean, that's a really, really key point because a lot of investors fall into that trap, doubling down on stocks they've got wrong, but they don't admit they've got wrong. And
Yeah.
if you hit, as I say, come back, if your hit rate is only is 2/3, which is a good number in smaller micro caps, means a third of them are wrong. So a third of the time stocks are going down. If you double down, you're going to get extremely lopsided onto a
Yes.
losing position. And I
Yes.
always say, if you're losing, you've got to make three. You've got to decide three outcomes. You either sell it, you hold it, or you buy more. And I rarely buy any more because I know I'm wrong a third of the time.
Very wise words again, Paul. I mean, I think that's true. I mean, I tried to write an article about this the other day about averaging down, because actually some of my best investments have been ones where I have averaged down. But it's where I think averaging down because the share price has fallen and trying to chase a lower break-even price, that nearly always goes wrong.
Mm.
But I think where you've researched it in depth and you're absolutely sure that you're right with your thesis, then adding to the position, I think not immediately after a profit warning. Again, that's a knee-jerk reaction. You often see buyers steam in when there's been a profit warning. And it all depends on the quality of the company, doesn't it?
Mm.
You know, averaging down on a really good quality, oversold company is one of the best investing strategies. But as you say, just chasing your losses down on something that you've fundamentally got wrong is just the worst. I've heard some disastrous stories of people who've done that,
Yeah.
you know.
Well, and I think the key sort of like or distinguishing trait in our situation is the company got a decent balance sheet, because
Yes,
even if the investment thesis is down, but it needs to raise money and the shares are down, it's going to be a bad result for you either way.
it is. It is. I mean, some of the discounted placings we've seen over the last couple of years are just horrendous, aren't
It's
they?
been brutal. It's been brutal.
Oh,
Now just turning tack. What about? I know I've spoken before, sort of Sosandar, which is one of those sort of like it's an online ladies fashion business, largely for 20 to 30% plus. And I guess the key question here, they seems to be doing terrifically, knocking the ball out of the park in like for likes and all this sort of stuff, is the increasing competition. One from the Chinese, because obviously they've been moving in and going direct to consumer, but also you've had a renaissance, amazing enough, and I can't believe I'm saying this, in the likes of M&S. I mean,
yeah.
ladies wearing M&S. I mean, what? I've never even heard of
It's
it. So,
great to see, isn't it? They've finally turned it round. So no,
so
it's
what? So,
wonderful.
so how do you see sort of Sosandar going forward then?
Well, I don't think the Chinese direct to consumer side is a threat at all, because that's right at the bottom end, and the
Right.
Sosandar customer is an affluent customer, who'll be shopping at the nicer brands. They wouldn't entertain buying direct from China, I don't think.
That's
So
fast
that's
fashion,
okay.
is it? That's sort of like your younger demographic fast
Yeah,
fashion.
Sosandar's not fast fashion at all.
Mm.
It's sort of next and a bit above in
Yeah.
terms of the customer. They've got very good repeat business, very loyal customer base at Sosandar. It's profitable now. The last update with Sosandar said that the growth rate had slowed to only about 10% in Q1,
Mm.
which I think for them, I think it's a March year end, so that's April, May, June. Now that did disappoint some people, understandably, because the full year forecast is 36%. So it's going to be it's going to be quite a big ask to get from 10% to 36% in the remaining 9 months. So I think the market, understandably, lost
Yeah.
some of its enthusiasm for Sosandar. So I'm not sort of saying Sosandar is a raging buy now. I'm saying it's doing all the right things, and its long-term track record is now established. It's a significant player in women's wear. The third-party deals are all going great. It's selling very well through Next and M&S, funnily enough, through their website. It's going into physical Sainsbury's stores imminently. They've just launched through an international partner on a low-risk way of doing it. So there's lots of stuff in the pipeline, and I think they've proven that they've got this niche brand that does resonate well with
Mm.
the customers. So I think, just as a long-term thing for me, I want to be holding Sosandar for 5 years plus, and I think
Yeah.
we should do very well in that
And
time
there's
frame,
been a
unless
lot
they
of,
get the fashions wrong.
yeah.
This is the
There's
big problem with the fashion sector, isn't it?
Yeah, and there's been a lot of M&A, hasn't there, in there? You've had Seraphine, which I know you benefited from, and you've had Mike Ashley's, sort of Fraser's, always getting bits and pieces. You've had Boohoo looking at Revolution Beauty and all this sort of stuff. So there seems to be quite a lot of M&A actually for good quality.
Yeah, I mean, a lot of it though is sort of picking over the wreckage, isn't it, of the
There is a
sector,
bit of that,
really?
yeah. Okay.
I mean, God knows what Mike Ashley's strategy is. It's just bizarre, isn't it? But I mean, he's I can't see the Kamani family at Boohoo in particular having much time for him being on the shareholder register. So I wouldn't be surprised if they take it private.
Yeah,
But I don't think they'll be generous to outside shareholders because
yeah,
they're canny rag traders. So I'm just generally avoiding that sector. I think
yeah.
again my sector knowledge when I was an FD in the 90s, I think is now a lot of it is out of date. So
Yeah, you
I
can't give it. You can't hang your boots up. You can't have your gloves up yet, there, Paul.
I
You're an
don't,
expert compared to me, that's for sure.
well,
I'm clueless.
I don't think I haven't really picked the winners in the sector. Although Sosandro's been all right,
Mm,
but Shoe Zone I missed, and I've missed quite a lot of the winners. So I
yeah,
don't think I've really got an edge in that sector. So it's time to look at other sectors,
yeah,
really.
okay. What about Card Factory? Because I know you're quite, but that's knocked the ball out of the park. With its
Yes.
stores, and it's surprising really because it's obviously been a beneficiary of Clinton Card's demise and when he went bust. But you've got that sort of secular sort of like not tailwinds or the headwind as much as anything to all things online. How do you see sort of Card Factory? Because it's really growing strongly despite what you'd think more longer term.
Mm. It's doing tremendously well, actually. I mean,
Mm,
I have top sliced my position in Card Factory because I was raising money to buy more plexus, but my enthusiasm for the share has not dimmed at all, and I
mm,
do want to go back up to a full position size in Card Factory when I can, when funds are available. Now, one thing I would say is I looked at the stock report on Stockopedia earlier today, and they've got this little graph showing the trend of broker consensus earnings
mm,
forecasts, and it's had two quite significant upward revisions.
mm.
Card Factory has in recent months, and the forward PE I think now is 7.5 or something.
Yeah, it's less than
Um,
8. You're right,
it's
less than
very
8.
cheap,
Yeah,
and the bank debt is coming down quite rapidly. The cash, I looked at the last cash flow
yeah,
statement, really very impressive cash generation. The new management, Darcy something or other, seems to be doing very, very good common sense things in terms of broadening the product range into complementary items that you buy at the checkout. And I mystery shop it occasionally myself, and the prices are very, very keen.
mm,
You can buy a bag of balloons and some happy birthdays, kind of streamer things, and a couple of quid each.
yeah.
It's
It's good
I think
value.
it's a brilliant business and very, very cheap. Now the only downside on it is the biggest shareholder is dribbling shares into the market.
Mm,
They put out a number of holding in company announcements showing them dropping 1%. I think from 18, then to 17, then to 16, possibly to 15. I can't remember. But that I think is definitely quite obviously causing an overhang in the market. But when that clears at some point, I don't know why they're selling. I don't know whether they want to sell all of them or just some. No idea. But I think that is presenting an opportunity.
mm.
Um, for you just wait for the overhang to clear and then the thing goes up. I mean, it's about £1.4 or £1.5 now.
Yeah,
I think it really should be worth £1.50
mm.
in due course if the current trends continue. So I think there's nice upside on that, and I think they're bringing in the dividend again, possibly next year. So medium term, I think Card Factory looks terrific. Yeah.
Yeah. Yeah, I know, Richard Crowe of Cockney Rebel from fame.
Yes.
He loves it, doesn't he? It's his biggest holding,
It's
so,
his biggest holding. Yeah. Yeah.
I'm speaking to him in a month's time, so I'll be interested to pick his brains on
Great.
how he sees that one. Now, what about, I know you've done a bit of sort of mystery shopping, XP Factory, the experiential sort of like leisure
Yes.
with Bloom Battle Bars and escape rooms. And escape rooms actually has benefited from sort of like the almost like strangely the work from home because I've had a lot of corporate bookings for team building
Mm.
at Christmas. So they seem to be doing pretty well. Could be a bit of an inflection point this year as well.
Yeah, I think I remain. I've got a significant, for me, size position in it. Yeah, I think it's very, very good.
Mm,
Management. I think Richard Harpham is superb.
mm,
I've met him a couple of times, and he showed me around the Oxford Street site, which I think he might have done for you and for
yeah,
Justin and a few other commentators. And the whole site just. The whole business just really runs off his kind of energy and
yeah.
enthusiasm. Really, I think you can. It's got a different feel to it to other businesses that I've visited, and it's very popular. The customers
Yeah.
really enjoy the sort of slightly retro themed games, a lot of
Mm,
them. And I think the experiential leisure sector is definitely taking a chunk out of the business that kind of standard regular bars
yeah.
have. And that was the reason I decided to part company with Revolution Bars,
Yeah.
which I only bought them around 5 or 6p, and I sold them at a small loss for about 5p or 4.9p or something. It wasn't a huge position, but it's got too much debt. And
Mm.
I think some of my readers persuaded me out of that one, actually, funnily enough. I was sort of writing up the positives on it, and the readers said, well, hang on, haven't you thought about this, this, and this? And they basically said that they feel the £18 million drawdown on the HSBC facility to buy Peach pubs,
Mm.
the readers on Stockopedia see that as a sort of management buying a life raft,
Yeah.
really, in that the core late night bars side of it is just. And your problem is, if your like for likes are down 10% when you're on a 75% gross margin, that 10% drop is ruinous for your bottom line.
Particularly when you've got cost inflation coming in as well.
Yes,
So,
exactly. Yeah, so I think Revolution Bars is a bit dicey. I think I just don't want to take the risk.
yeah.
I mean, look, somebody could come in and bid for it for 10 or 15p. I just don't know, but it's the debt that I don't generally want to be holding companies with debt right now, because the days of leniency and zombie companies when the interest cost was only 0% plus 1.5 margin or something, the
Mm.
banks were happy to let them just bide their time and trade their way out. Now that the interest is accruing, and some of these companies, say SuperDry, for example, it's only got borrowings on 10, 12, 15%.
Mm.
Well, that compounds quite badly, doesn't it?
Mm. Yeah, and I
See,
think
SuperDry came back from trading today, didn't it?
I didn't know.
Yeah,
How did the
yeah,
shares
40.
respond?
They're down about 15%, I think.
Right.
45, 46p. I think that could go bust next year.
Mm. Yeah,
I'm
I
not.
mean, basically, I think it does seem as though the consumer is getting far more discriminating. It's got a certain budget that it's going to spend on, its leisure and its retail, and the winners are going to be stronger and get through the sort of like the softer patch. Whereas the weaker guys in a higher interest rate environment are going to really
Yeah.
struggle, if not go bust.
Yeah, I mean, the interesting thing with SuperDry, though, is that they did actually get the money in for that £35 million
Mm.
IP sale,
Yeah.
which does actually in the Far East, and that does prove that the brand actually is worth something.
Mm.
So, you can argue it both ways, but I just personally, I wouldn't want to take the risk. I got clobbered with Jules,
Mm.
where I stubbornly thought I knew best and it would recover, and it
Yeah.
totally crapped out. So
Yeah.
I think I'm just not going to get involved with any more struggling fashion businesses. It's such a low percentage of them actually to do turn themselves around. That's the thing.
Yeah, well, turnarounds are high risk, and you make great returns on the back of them if you get them right, as in like the shareholders do. But if they go, most of the time they're high risk because they don't go right, and
Yeah,
it's harder than you think. Yeah,
no, that's all
I,
right. And there was
I think
something
you're right.
interesting in the paper about Hilco as well. They do the sort of
Yeah,
lender of last resort,
yeah,
and it was saying how they basically lend at high interest rates to struggling retailers. So they've got their foot in the door for basically
yeah, okay,
effectively taking over the business and buying all the stock for pennies
yeah,
in the pound when the thing goes bust, and they make money, in 2 or 3 different ways.
yeah.
So really, seeing Hilco as a second lender to SuperDry is
Mm.
actually quite a red flag, I'd say.
Yeah, and Hilco they've got a checkered reputation. I was thinking a few of those haven't gone their way either. So it just shows you how difficult it is to change the psychology and perception of consumers to
Yeah,
if
but
something's
as they're
gone.
they're usually the big secured creditor.
Yes,
They call the shots in the administration, and they make money out of the administration, apparently.
yeah, but
So,
but overall they can still lose. I've seen a few of them where they've even gone through pre-pack deals. But anyway, regardless,
mm,
what
yeah.
about SCS, the sofa guys? Because they were a pandemic winner. They still seem to be gaining market share, and they've got this cash mountain, which is just enormous on their balance sheet.
Yeah, it's about the same as the market cap. And some people say, oh, it's not really their money, but it continuously rotates. So it'll
Mm,
always be there. And if you look at DFS,
mm,
they've stripped every penny of that cash out, and they've maxed out their overdraft as well. So you
yeah,
can
okay.
extract that cash. But what's interesting is I would have thought private equity would be all over this, but
Mm,
the private equity guys don't seem to be interested in value type plays, do they? They're
mm,
only going for these
yeah,
structural growth,
mm,
particularly software and healthcare type
yeah,
businesses. So SCS just sits there languishing. But yeah, I think risk reward on it's very good. I did dip my toe in recently with a small purchase on SCS, and I think as funds become available, I'll buy more. I think the yield is about 8.5% on SCS now.
yeah, okay.
And they've been doing buybacks, I think, as well, which enhances your EPS and your
Mm,
DPS. Uh, probably not the best management out there. I think
Mm.
DFS is a much better business, but it's got diabolical finances and balance sheet, whereas
Yeah.
SCS, I think SCS is having a badish year, but it's on a PE of about 10 in a fairly suppressed consumer spending environment. So the way I look at that is that in more normal trading, economic circumstances in a year or two, SCS could be a 50% to 100% gainer from the current level, and you've got absolutely no solvency worries, and somebody might well come and bid for it as well for the cash pile. So
Yeah.
yeah, I think risk reward on SCS is pretty good actually.
Mm. You raise a good point on private equity in terms of what they're looking to buy, and the reason is they tend to go for these, secular growers in
Mm,
tech or healthcare with high gross margins, and where their expertise is basically bundling a bunch of those similar businesses together, stripping out all the overheads on a high gross margin, high unit economic type business, and
yeah.
therefore it just drops straight down to the bottom lines, and then they relist it or sell it as a bigger business on a higher multiple.
Mm.
It's that buy and build, and then they have, and that's the easiest way to raise money, particularly in a higher interest rate environment from investors. But if you're looking for private equity to buy companies, then it's technology, software, and healthcare.
Yeah, it is, isn't it? And that's kind of your sweet spot as well, isn't it? So,
Yeah, well, yeah.
um, I'm listening much more closely to what some of the stocks you cover,
Don't,
because they
don't.
could well be bid targets, some of them.
Oh, some of them could be big targets, but yeah, I have my travails. I get blown up many a time. Don't worry. So don't follow what my portfolio is doing. That's for sure. Sanderson Designs, which I think does is sort of like it does sort of wallpaper and decorative designs for
Yeah,
houses, improvements, and this sort of stuff. How do you see this one playing out?
I like this one. I bought quite recently
Mm,
on a update. Everybody keeps expecting it to warn on profits because
yeah,
it's sort of middle to high end fashion
yeah.
orientated fabrics and wallpaper and
Bit
so
like a
on.
Laura Ashley sort of like
Yeah,
revisited.
yeah, they got 5 or 6 different brands. I tell you, there's a similar one, a smaller one called Colfax as
Yeah.
well, which is quite obscure. That's in a similar type of vein. Sanderson Design Group, yeah, but it keeps putting out reassuring inline trading updates,
Mm,
and Sanderson does. And what it's basically been saying is that um, there has been a slowdown in the wallpaper and fabrics division, but the licensing division is putting in a barnstorming
mm.
performance, and licensing revenues are normally valued on quite a high multiple. Although, actually, as some of the reader comments pointed out, the licensing deals with Sanderson tend to be quite short term. So, quite a few of them are, for example, for a 1 or 2 seasons range of clothes with Next, or that sort of thing. H&M, I think, did, and of course, it's got this design archive, massive historic design archive. It owns all the Morris and Co. designs, the William Morris designs, and it's got some. I think at some point somebody might well buy it for that back catalogue, which
Yeah.
does seem to have. I don't know the ins and outs of how design trademarks work, but it does seem to have watertight intellectual property over these designs. And there's been a deal with Disney recently, which I would imagine could be quite lucrative. And the CEO, Lisa Montague, is a force of nature. I think she's brilliant. I interviewed her a while ago,
Mm.
and she's really done a lot of very good commercial stuff at Sanderson, and the balance sheet's absolutely bulletproof, got
Yeah,
loads
plenty
of
of cash.
cash. Yeah. I think, you've got to accept that. I think for me, I like to have a basket of things like that.
Mm.
And I know in a situation like we've got now, one, maybe two of them will warn on profits.
Yeah.
You can't avoid it. I wish I
No,
knew
I'd
which
agree, yeah.
ones. But actually, the interesting thing is, on my top 20 watch list for this year, where I flagged up my sort of value GARP type picks for the year, that's actually up 6% year to date. So that's outperformed AIM by 18%, which I'm
Mm,
very pleased with. But that's within that list, there've been, I think, at least 2 profit warnings.
mm.
So it's quite interesting, isn't it? In that within a diversified portfolio of 20 shares, you can absorb a few profit warnings.
Well,
So
I mean, my portfolio this year is about that 6% up, but I've had about 3 profit warnings. So yeah, you can
have
absorb.
you?
Yeah, you
Yeah,
can absorb it,
you
but
can absorb them, and yeah, and if you have one takeover bid,
yeah.
that'll mop up at least one profit warning. So what were your 3 profit warnings then, Paul, out of interest?
I've had one
Would you
was a
rather not?
one was one is an office. I've got. I mean, they had a profit. Well, it is a profit warning. It's a census which does software for large scale buildings for work from home sort of stuff. Anyway, it's been a nightmare share for me.
Oh dear.
I've had
I
another
wish I
one.
hadn't asked now.
No, I know there's that one, and then I've had Inspiration Healthcare had a profit warning last week, small one last week. So I'm hoping to
Mm.
speak to the CEO, and then I unfortunately got absolutely taken to the woodshed last. Luckily, it was a smaller position, um, Sondrel. So
Oh
which
no!
I know,
Oh
yeah,
God! Sorry to hear that,
no, no, no,
Paul.
no, 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 absolutely, yeah. It was basically, I mean, it was only 60% down on the day, so it wasn't a big hit, you know. What?
I
So
had a look at that one last week. I think it's bloody awful, I have to
yeah, I
say.
know, yeah. Well, I mean, just to let you know, I've sort of like had a good look at it, and I'm going to hold it. And the reason why I'm holding it because the investment thesis is still there as long as they can get through the short term cash problem which they've got,
Yeah,
and they should be fine for this year. Because one thing, you know, if you look through the balance sheet and the cash flow statement, they've got a working capital unwind from last year because they had a large tier one OEM EV manufacturer who hadn't paid them 4 million quid, which came in the first half.
I
So
noticed receivables were
yeah,
peculiarly high, but they've got weird and large creditors
yeah,
as well, haven't they?
and that is SaaS software they've bought,
Yeah,
just the way they do it, and that's over 3 years. So essentially, what they've got is their SaaS software is about, I think it's about 200,000-300,000 of outflow each is a commitment each month, and they've got
wow,
a similar amount on their salaries. And if you put it all in, they need to hit their engineering division needs to hit about 15 million a turnover. They're currently
mm,
on 13. Need to hit 15 million a turnover. It's much higher margin to
yeah,
basically be cash flow break even. So the the big problem which they've got is, are these three delayed contracts, are they synonymous with the industry stopped? As
mm,
they basically not going to get any more orders? And if that's the case, then they're going to really struggle in 2024.
yeah,
Or is the US, which is buoyant, going to be able to get them out of the pain point, and
mm,
they can win contracts and deliver the 15 million pound plus for next year?
yeah. So I've got to ask you, Paul, if you didn't hold it already, would you buy
No,
now?
so I'm holding it now. No, no, no. I'm not doubling down. That's for sure. No, no, no. I mean, the thing is such that what they've got their customers are things like Tesla and Apple, and lots of electronics manufacturers, and it's a two-speed industry. The US is absolutely flying, but
Yeah.
Europe and Israel is really struggling, and because it's the two-speed situation, is the US going to slow down like Europe in the ASIC chip design, digital chip design, or alternatively, is the US going to carry on and continue going gangbuster, and they're going to get through it? And hey, I don't know.
Mm,
There is an argument you could say you want to just get rid of it just for the sake of it, but there is a large seller actually at the moment, which is why it went down so much,
yeah.
and therefore it's sort of like pretty low. But I,
Well, this is also, I think, a structural problem with recent IPOs in that because of the way brokers float things, they usually just place large blocks of stock
mm,
with a 10 or 12 institutions, usually the same names, and so there's no aftermarket liquidity, is there? Particularly if
no.
everything goes wrong, everyone's just left high and dry. So yeah,
Well, they had, and so when you had one institutional shareholder, and they haven't announced who it is, selling 5 million shares, it goes down by 60%, which is what happened. But I mean, the thing is such that you and I have been through these kind of things, and it comes down to emotional stability. You know you're going to be wrong. You just don't know which socks you're going to get wrong.
yes,
And at the
yes.
moment, this is what I've got badly wrong. It's cost me a lot, but
Oh dear.
mentally I can get through it. Financially, I can get through it. And on that basis, then you learn it. And if you look at it on a positively basis, if they do come through, then it will do well next year as a potential
Mm,
upside. If it goes south, then it's a very small position now compared to
Yeah.
what it was. So it isn't going to do. And but more importantly, it gives you as an investor hunger, and it gives you a reality check that if you've been through a good patch, you know, you'd, you just wait until you get smacked in the
Yeah.
face, as Mike Tyson says, because that's what it will happen. It's just as a matter of when. And if it gives you that more hunger and more passion and desire to, look for other opportunities and to improve
Mm.
learn from it. That's it. It's a learning game, is it? Continuous
It is.
improvement.
And do you find when you've gone through a really good patch, like a lot of us did in 2020 and 2021,
Mm.
you find that you, without realizing it, you greatly lower your quality
Yeah, you can. Yeah, you can throw the
selection,
dice. Yeah,
and you can end up just punting on things that in normal circumstances you wouldn't touch.
yeah.
I definitely find I do that.
Yeah. No,
Mm,
absolutely. It's natural. It's human nature, isn't it? And
yeah.
you've got to pinch yourself. But I think the big picture is that if you go through a lucky patch, and I've been through some lucky patches at time when you have three, four, five, you do really well in a couple of years, this sort of stuff, and your portfolio roars. Then equally, you can, because we both carry a lot of idiosyncratic risk. You can have a similar period of a 1 or 2 or 3 years when actually you do a lot worse than the actual market, and you've got to
Mm,
get through it. But overall, the direction of travel is still up, sort of mid
yes,
teens, which is a great overall return. But you've got to
it
go through
is.
that fluctuation to get to the end point.
Yeah, and I think also it's very easy to start doubting yourself and saying, "Look, am I actually any good at this? Maybe I'm just no good at it." And
Yes,
but I think the way to respond to that, certainly what I've done this year, following on from an awful year last year, is just to work harder and
yes,
just to raise those selection criteria
mm,
to this stock picking business is really a game of elimination, isn't it? You're looking
yeah,
at hundreds and hundreds of
yeah,
opportunities, and I find I do best when I eliminate nearly all of them,
mm,
and I literally just distill it down to a handful of key
mm,
stocks where I think I've genuinely found something um, that's highly advantageous to me,
yeah.
and that then lays the groundwork for a big recovery, doesn't it?
It does, yeah, yeah, and it's risk management and also risk and reward, because as you talked about with plexus, is looking at the downside as well as the upside. The upside's enormous, but if it goes wrong, then you're going to be
Yes,
able to walk away. It isn't going to change your quality of life or your family's
yes,
quality of life.
that's
It's
right.
gonna
Yeah.
mentally wise, it's going to dent you. It's going to dent your confidence. But it isn't a sort of like an all or nothing. You never want one stock to break you, basically.
No, and I think because I've suffered catastrophic losses on the spread bet accounts in
Mm,
2008 and again actually in 2022,
mm,
I think I'm kind of hardened to risk and to losses.
yeah,
If my ungeared portfolio has dropped to 20 or 25%, I just kind of think, well, let's just
yeah,
let's just get it back. It'll take a
yeah.
couple of years to get it back. Get on with it. Whereas I know a lot of friends, particularly the younger investors who maybe have not been doing that long, who are utterly distraught.
Mm.
Perhaps almost quite seriously, some of them almost having breakdowns and
Yeah.
wondering whether they should tell their wife that they've messed up and all this sort of thing. And it's very worrying. That's why I just think it's just best for everyone not to use gearing. It's
Yeah.
just an accident. It's an accident waiting to happen.
Yeah. No, I move well away from derivatives. As Warren Buffett says, they're weapons of mass destruction, wealth
Yeah,
destruction, I think
yeah.
maybe he
Tell me
calls them.
about it.
I know. But there's another one. Is like, if you're a sort of an investor and you get, the classic IFA question when they come to an investor is, what's your risk tolerance? And they have all this sort of catalog. But frankly, you can bin that, because the only thing that tells you what your real risk tolerance is when you blow through it, and then
Yeah.
it's real painful, and that's when you really know your risk tolerance. And I've been through it, and as you blow through it, your risk tolerance, you get hardened to it over that
Mm.
period, because I mean, let's be clear about it. You know, I've still got a smile on my face, and Sondrel lost, was 60%
Yes.
decrease on last week. Not that I didn't sleep well. I haven't slept well since, but I mean, you've got to basically get through it, haven't you? Simple as that.
Yeah, it's part of the process.
Yeah,
We all have to accept profit warnings, and that's just the way it goes sometimes, isn't it?
yeah. But
Well,
anyways,
well
on
done
this,
for well done for coping with it so well, Paul.
I'll go and have another Valium tablet.
Well, actually, I'm feeling quite chilled out today because I had a can of drink that I don't know what I've done with it, containing CBD, which
Oh, well done. Okay.
yeah, I've never had it before, and I thought, well, should I be having this just before doing an interview with Paul?
How do you
but
get? I've
I
never even heard there's a can that you can actually. I didn't think
yeah, it's in
you could buy
Sainsbury's.
cans with cannabis in
Yeah,
it.
it's meant to chill you out, isn't it? So,
Did you
but
get no, exactly? Did you get it from Holland or something?
no, just the local Sainsbury's.
Really? Wow. No,
Part of the meal deal as well. So yeah,
okay, right.
there
I'm
you
gonna have to
go.
go. I've nipped down my local supermarket then.
Yeah.
Now we're just on the chip designers,
Mm.
CML Microsystems, which doesn't do the sort of the low nanometer digital chips that Sondrel does. It does a sort of like the RF and the wideband, more for sort of industrial applications, I think, in Internet of Things and 5G. Should I take us through this one because
Yeah,
it seems to be doing pretty well.
yeah. I mean, you just asked me to flag up some interesting stocks that
Yeah,
I'd reviewed in the last 3 months on the small cap
yeah,
value reports, and this one came up where it's not one I hold personally, but I do think it's interesting because it's dropped by about a quarter in the last a few
mm,
months, but actually the fundamentals reported have been good.
yeah,
It's an interesting special situation where it's got surplus cash and surplus freehold property. It's developing the surplus land. It's like a business
mm,
park that it owns. It's developed. It's finally, after years of waiting, got planning permission. So I mean, the market knows about that. That's all in the price. But I just thought you've got a nice thing here where you've got downside protection with the cash and the property, which supports about half the market cap,
yeah.
and you seem to have a nice little business that's also actually trading rather well. And when you adjust out the
Mm.
surplus assets, the PE ratio is quite cheap. So just it might be one that
Yeah,
people might
yeah.
might like to have a look at. I don't have a particularly strong view on it, and I've got
Mm.
no idea what it does. I don't understand the
Okay.
products at all.
Well, but it's obviously got some IP there. Now,
Yeah, it
one
looks
thing I
it's
think
been around a while. I think it's quite a nice little company. Yeah.
yeah. Now, one sector that he's done pretty well on is defence. You've got Cohort with a huge order backlog. I think you've interviewed the CEO there, and
Yes.
MS International, which is a similar large. It's got a number of divisions, but its defence is the biggest with a big order book, and it's got this anti-drone type weapon which is
Yes.
developed. So do you want to take us through your latest thoughts on both of those? Because they must have huge visibility given the war in Ukraine still ongoing, I guess.
Yeah, well, that was really what drew me to both of them, actually.
Mm.
I mean, I've been aware of both Cohort and MS International for years. They've been around for quite a while. But I think they're both particularly attractive at the moment because they've both received very large orders for, in some cases, for new products, and so you've got these multi-year order backlogs that give
Yeah.
you, as you said, tremendous visibility. Cohort, I think, is on a forward PE of only about 13.
Yeah,
And now,
14. Yeah, yeah.
yeah, historically, it's always been rated a lot higher.
Mm,
So it's had a D rating, and yet the fundamentals are good, and the order
mm,
book keeps growing. And I think they've had 6 or 7 large contract win announcements this year. So I think this is a bit of a coiled spring for a re-rating. I would expect
mm.
Cohort as the next bull market emerges in small caps, which will happen. We just don't know when. I think you could probably look at this re-rating up to a PE of 17 or 18, and
Yeah.
you get a nice, dividend in the meantime. Management struck me as very capable. I
Mm.
interviewed the CEO, Andy Thomas. I just do CEO interviews for fun, really, for
Yeah.
interesting companies. I don't charge for them. I just enjoy doing them, and he helps me understand the business model. And I think he gave a very good account for what they're doing at Cohort. So yeah, I think it's a nice quality company on a value share rating. So
Yeah.
have a look at that one. CHRT. Now MS International is slightly different. they've just announced actually on Friday a big contract win, I think from the US Navy. Very unusual for British companies to be able
Yes.
to sell products to the US, and it's for large caliber guns, I think, for warships, destroyers or something. And as you know, there are large numbers of destroyers. Hundreds or dozens of them in large naval fleets. And one thing I didn't understand, though, it announced a maintenance and support contract win, but it hasn't actually supplied the guns yet. So it seems to have been announced the other way around, which people who know the company better than me are speculating means that the actual big contract to buy the guns must be in the bag, because you wouldn't sign a support deal for it. So that's a bit peculiar. So I don't understand that bit. But now the other angle on this is that the director's got, I think, 4 different divisions MS International has. Both sort of all unrelated and quite weird that they're in a group, but they're all good, high margin niche businesses. And the guys who run MS International have been running it literally forever, decades. They've worked there, and they're all getting on a bit now. And so I think it's one of those situations where it's probably going to be maximized for sale value when they want to retire, probably in the not too distant future. So, and I've done very well on situations like that in the past. Avesco was one where precisely
I remember
that. Yeah, and that we got more than 5 or 6 bagger out of it. And the value was obvious. It was just sitting there on a plate, but nobody was interested. But the owner wanted to sell it so he could retire, the founder, CEO, and so he closed down the loss-making bits, or sold them off, and suddenly he had this fabulously profitable business, and he got a real premium bid for it as well. So I think you could have something similar happen at MS International. Very, very illiquid, very tightly held.
Yeah, how did you buy shares?
Nice business.
How did you buy shares in a liquid stock like? Because I've bought shares of this about 10, 15 years ago, and I struggled putting about 20 grand in. It was like,
yeah, you'd have to break that up probably into 4 purchases.
it was amazing.
Yeah, but you see, I've got one of these internet dealing accounts now where I'm only paying £5.95 for each trade. So there's no problem with breaking it up into 4 or 5 grand parcels. You just nibble away, wait for it to go red one day. That means somebody's selling, and and it'll quote you a spread of sort of £7.10 at £7.70. But actually, you put in a dummy trade, and you can probably buy it £7.20. So I don't know what the market makers are doing with these prices they quote. Are ridiculous, because it deters people from even bothering to look.
Whereas, I give up if I can't get a reasonable chunk easily. I just say, okay, it's too small for me. I can't get the liquidity. I'm moving on. I think.
Well, I tend to be more patient. I mean, I think my position sizes are a lot smaller than yours these days. But I'll happily just nibble away at it over maybe a few weeks and months.
A few beers, a few cannabinoid tinnies.
And you can build up positions gradually. But the trouble is, then if something goes wrong, you can't get out.
Yeah. So, I mean, what it just annoys the hell out of me is such that to build up a big position. I'd be there for like 4 weeks or a month or 2 months or something like that every single day, and I just haven't got the time or the patience to do it. And I just think, forget it. I've just got to move on. If there's no liquidity in it, it just isn't for me.
Or you can just ring the house broker and say, put me down on your list. And if an institution wants to sell some, give me a call. I've done that before.
True. Anyway, I think they're both very good. And the other thing about MS International, hasn't it? It's got that really quite unique anti-drone gun as well that seems to be.
Yes.
I mean,
that looks good.
Well, given the amount of drones flying around Ukraine and Russia at the moment, you see how it strategically it's changed the whole sort of like land battle defense and the naval defense. So if you've got something which does that and can shoot these things out the sky, then it's going to sell a lot.
Yeah, absolutely. And I think MS International has announced, again, similar to Cohort, has announced some large contract wins in the last 6 months. That was actually the catalyst for me buying into it, actually.
I think you've chosen both. Well, I mean, I haven't got any defence stocks, but I think both of them are top draw. Love to buy them. Okay, so Zotefoams, industrials, which does a sort of like I think it's sort of driven by sort of secular growth for sort of HVAC and global warming and all this sort of stuff. But it does sort of foams and insulation, doesn't it, for sort of like high value
Yeah,
items?
yeah, it's specialist high performance foams where it claims world leadership in terms of technology and know-how.
Yeah.
And I think that's backed up by the fact that it makes pretty good margins.
Mm.
The biggest product is specialist trainer soles for Nike, and
Right. Okay.
Nike. Yeah, and I think that's about 40% of its business and pretty good margin. Nike's just renewed an exclusivity agreement with them, I think, for another 5 or 6 years. So that's good.
Those are the Air
Um,
Jordans you're wearing at the moment.
I don't know which products they are, but it's staggering the money people will pay for these
Only
for the
$300
trainers.
for an Air Jordan, so it's cheaper, half
God,
the price.
amazing, isn't it? Yeah, and they do. They're benefiting as well from the turnaround of the aviation sector. So
Yes.
that got clobbered
Yeah.
during the pandemic, obviously, but now that's building back up again. I think the Zotefoam supplies that, and then so they've got some nice sector tailwinds. Same with automotive
Mm.
recovery there, as the semiconductor chip shortage turns around. It means production's rising. I was very impressed with the way management handled the energy crisis at
Mm.
Zotefoams. They were able to pass on all the additional costs to clients. I mean, they made it look easy. I'm sure it
Yeah.
wasn't easy but the fact that they were able to pass on those costs.
Yes.
Whereas you look at, say, for example, a company like McBride or
Mm.
other consumer manufacturers, they got absolutely clobbered because the supermarkets wouldn't accept any price rises, or they were delayed. Whereas Zotefoams, they didn't skip a beat. And so I think actually with both the pandemic and then more recently with the energy crisis and higher inflation, we're really getting some fabulous information on all these companies
Mm.
about the strengths and weaknesses of their business models.
Yeah.
You know, and companies that have got through these multiple crises, intact and with great skill and so on. And really, it's telling us those are the ones to be investing in for the future, isn't it?
Yeah, I think you're
Um,
exactly right. I think it's a really good point. You've got such a sort of like, you know, it's a case study, isn't it? If you've got a business
yeah,
that comes out of all the knocks we've had the last 3 years, still maintaining its growth and margins, then it tells you it's got real economic resilience, and
it does.
it's a
Yeah,
master of its own destiny rather than being sort of buffeted by it just totally external fact. I would say with Zote phones, it's about 170 odd, 180 odd million market cap business.
yeah,
I would not be surprised if an industrial trade buyer is looking to pick these up, given the
yes.
quality of the asset.
Yeah, I agree, and it's also got the cherry on top, if you like, is this resource with a Z,
Mm.
which is their fully recyclable drinks carton
Yes.
that's in development. They're spending about £2 million a year on developing that. So you could arguably add that onto profits and
Mm.
say, well, that's a separate
Yeah.
project. That if it doesn't work, we'll just drop away and
Mm.
profits will go up. If it does work, it could be
Huge.
a big seller. So I like to have something a bit blue sky thrown in for free.
Yeah.
Um,
Absolutely. Yeah.
and interestingly, going back to your other points, so Sandar Management on the Q&A I did with them a little while ago, they said we've never known normal. They started
Yes.
the business, I think, in 2017 or 2018, and it's
Mm.
been just one massive crisis after another ever
Yeah.
since.
Yeah.
And they've grown and they've taken market share and they've moved into profits. Well, that tells you once things are more normal, that business is probably going to fly.
Yes.
Um, yeah.
That's a good, absolutely really good point. Gives you that resilience, and
Mm.
gives you, some more certainty as an investor. We can get through the toughest times. Another one which is sort of like really upskilling actually is Volex, which is a large
Yes.
company, Nat Rothschild sort of baby, and they've been on a buy and build strategy, but now they do sort of cabling and all this sort of stuff. But they've really started moving to healthcare with MRI scanners into data centers, and I think they've even got a contract now with Tesla in their, in their
Yeah, they've had
business.
all of those for a while, actually,
Yeah.
Paul. Yeah, but it's the strategy. I mean, now Rothschild's has worked wonders at
Mm.
Volex. I think he really has, and he owns 25% of it. Although I think his shareholding in Volex is probably worth less than his super yacht,
Yeah.
which apparently is moored off Corfu or something half the time. So, so you would think, well, maybe Volex is just a plaything for him. But
Mm.
it seems to me he's really committed to it, and
Yeah.
wants to, if you like, prove that he can run and build a great
Mm.
business, I think. So I don't know. I've never spoken to him, but he sounds really upbeat on the webinars, and they're doing acquisitive growth. So
Yes.
it's a sort of buy and build type thing, really. And they don't seem to have put a foot wrong. They've
Mm.
just announced and just completed another big acquisition in Turkey.
Yeah.
That's at least two fairly chunky acquisitions in Turkey, which is obviously benefiting from reshoring
Mm.
because it's got a global footprint. Volex has now, and each deal they do, you can see exactly why they've done it. It's complementary markets, complementary products. Excuse me, buying synergies. I like acquisitive groups. Actually, conventionally we would often a lot of us would turn our nose up at acquisitive groups because so many of them went wrong and they had to write off the goodwill and all the rest of it.
Mm.
But I think actually now I'm changing my mind. Where they're disciplined buyers of businesses in the same sector that they know inside out, they know exactly what they're buying it at the right price. I think it can create a lot of value,
Yeah.
and in particular retirement sales.
Mm.
We've seen that from SDRY, from Judges Scientific, and I think Volex now is also picking up on companies where the owners want to retire. I think Ticker Murat was one like that.
Mm.
So yeah, I think it's basically a successful buy and build group
Mm.
that's really well managed, and it's on a value share rating with a PE of about 12 or 13.
Yeah, yeah, and you can see it coming through on the EBIT margins. It's over 10% now. So
Yeah, yeah, it's
that
making good margins.
that just shows you that there's good IP there, no doubt
Yeah,
about it. And you're
yeah,
right in terms of if you've got a blueprint for your integration, having done acquisitions, it's just really keep turning the wheel. The
yes,
hit
yeah,
squad come in, they know what the price they've paid, they know what the synergies they need to do, and
exactly.
it isn't learning going up the learning curve. You've just
Yeah.
basically you know what you're going to deliver, and that's it. You deliver it.
Yeah, I think the acquisitive groups that go wrong is either where you've got just delusional idiots running the company who think they're great deal makers but aren't, or it's where they buy something that they're diversifying into a
Yeah.
sector that they don't know anything about.
Mm.
That's where the really big clangers seem to happen, isn't it?
Yeah, yeah,
Or if they buy something that's fashionable,
mm,
something that says does AI or something, and they
yeah,
pay some insane ratio of it, and they borrow the money for it. Those are the type of deals that go wrong. But
yeah.
I think
Any
Volex is
any company which says an adjacent market, then you've got to basically it's a red flag, isn't it? So be warned. And
yeah, good point.
another one which is a fairly successmal buy and build is Renault, the chain boys, and
Yes,
they really
yes.
seem to be sort of like doing well. I mean, in terms of the quality and the margins. You've got your latest view on these guys?
Very positive. Again, I should declare I own shares in Volex and Renault. They're
Mm.
sort of long-term core holdings of mine. Yeah, Renault, very, very good turnaround. The guy running it's excellent. I think it was a slow turnaround that took years and years, but
Yeah.
it's worked, and he's now really on the front foot, buying complementary businesses. I think they bought one in Spain. They've just done a tiny acquisition in Australia. Again, it's industrial chains and torque transmission couplings and gearboxes and things. So they really know their sector inside out, and they're just bolting on good businesses.
Mm.
Often, again, retirement sales. They pay a low EBITDA multiple for them. They know the markets, and yeah, it's just rinse and repeat, really. And the extra benefit of what they're doing at Renault is that each acquisition helps dilute the pension problem.
Yes.
So it's a bit like what Norcross are doing. They're just gradually, slowly over time, the pension becomes less of an issue, and they've managed to fully support it for many, many years without doing any equity dilution.
Yeah.
And now it's self-funding acquisitions as well. So yeah, I think Renault, for a nice, patient, long-term
Mm.
buy and hold, I think will do well on that.
Yeah.
And
Well,
again, somebody will probably come along and buy it.
yeah. I mean, with a PE of less than 6, then yeah,
Yeah, I
absolutely,
mean
it's
that's
brilliant.
because of the pension deficit.
Yeah.
That's
Exactly.
swallowing
Yeah.
up
Yeah.
about 5 million a year, which obviously doesn't go through earnings, does it?
Yeah.
So, even allowing for that, it's too cheap, I think.
Yeah. Well, another turnaround, Restore, which I think you've had a good look at. What's the latest on this? Because they've had a profit warning, haven't they? Which is, I mean, basically what they do is sort of archive old companies and NHS and
Mm,
healthcare and all records, put it into big warehouses for long term, look after it,
yes.
and so they can bring it back or they scan it. And this sort of first of all, what was behind the profit warning, and then secondly, how are they going to sort of resolve it?
Well, actually, the core business is doing okay.
Mm.
The problems seem to emerge at it tried to sort of move up the value chain and buy a load of complementary businesses,
Yeah.
IT related,
Yeah.
and that
Okay.
doesn't really seem to work, basically. And the CEO who was behind that strategy had to walk the plank.
Yeah.
And anyway, I mean, it was previously a real sort of go-go share, a growth
Yes.
company that was going up and up and up. Everyone thought it was great, but it's absolutely tanked
Mm.
so it came up on one of my filters as just one of the biggest fallers. So I thought, right, well, I'll add that to my watch list, and when it next updates us, I'll have a look at it and put it up on Stockopedia by
Mm.
before the 8 a.m. opening bell, if it shows any signs of life. So anyway, it did. The most recent update, I forget when it was, maybe 2, 3, 4 weeks ago or something, basically said that things are not getting any worse.
Mm.
It said we're reaffirming guidance that we gave you a couple of months ago, which wasn't that much reduced from the previous forecast. And the main issue I was worried about was debt. Anyway, they gave updated numbers on debt that showed that it was reducing, that it was under control, the covenants were not going to be breached. So I looked at this and I thought, do you know what? This thing's oversold. We're going to get a
Mm.
bounce out of this.
Yeah.
And the shares were £1.25. So as you know, I never give recommendations to the readers, but I did say, look, have a look at this. As I think the conditions are now set for a bounce, because
Mm.
it's not getting any worse. It's very, very cheap, and debt isn't a problem. So I think this is going to bounce, and I might buy some myself, which I did. I waited to see what happened in
Yeah.
the first hour of trading or so, and it did actually drop a little bit further, but I couldn't buy any. There was no liquidity.
Mm.
But anyway, I managed to pick up a few, not a lot, of Restore at around, I think, between 125 and 130.
Yeah.
And I said I think it's worth about £1.72,
All right.
which
You're pretty good then.
sounds very precise, but that was just working out,
Yeah.
a modest lowish PE on the revised guidance and taking off a bit for the debt. And I said, look, I think this thing's 30-40% too cheap. Anyway, it played out perfectly.
Mm.
Over about a 2-week period, it rebounded to £1.70. So
Yeah.
we got, I think one or two of the readers bought some as well. So we got a nice 30 or 40%
Yeah.
quick profit out of that. And
Well
I
done.
think that's what so you've got several opportunities at the moment. One is
Mm.
loads of takeover bids coming through.
Mm.
The second one, I think, is being quite nipping in and out of these bounce type
Yeah.
situations where things are oversold, and you get an up, so you're up at 7, you're reading quickly through all the updates,
Mm.
and every now and again I'm finding one where I'm thinking, oh, that's overdue a bounce. And
Yeah.
sure enough, we're making some quite good money on some of these things.
Mm.
So maybe we're all just turning into traders.
Yeah, no, I mean it's quite an interesting sort of like observation, because to make profits, you've done really well this year. Not only have you had a few sort of takeovers, but you've had a shorter than usual time horizon where you've traded some
Yes.
in and out some quite good shares. I think there's likes of what was the one which had that real problem with its contracts? I can't remember the technology.
Oh,
Wandisco, you
oh,
went in and out.
Wandisco. Yeah, that was
Yeah,
horrific. Well, I got all my money back on
that
that.
exactly. Yes, you traded it well, didn't you?
Yeah. Well, when it came back from trading, it dropped from £9.50 to 50p.
Mm.
So I increased my position size by 35 times.
Yes.
So I mean, talk about averaging down.
Yeah. On a special situation.
Special situation. I think it'll go to £1, and it
Yeah.
did.
Yeah.
So I got all my money back from,
Well done.
and the key thing was it was fully funded, because
Yes.
it had done a placing, so you knew you didn't have to worry about
Mm.
cash for a few months. And I only wanted to be in it a few days, really, or
Yeah.
a few weeks, and that one worked out. Tiny build, I did very
Yeah.
well on, and an institution dropped the price 80% on a profit warning,
Yeah.
bottomed out about 5p.
Yeah.
Well, you couldn't get them at that level, but I think I bought at an average of 7.5p,
Mm.
and it rose the next week to 13p. So
Yeah.
I do think these bounces, if you pick them carefully and you really do your homework, I think there's nice opportunities right now.
Yeah. Well, as I say, it's more short-term risk and reward, and you need real skill to be able to do that. I can't play in that game. It's just it's too
No,
tough
that's
for
fair
me.
enough. And I would say as well, Paul, it's not either or. I mean, I've got most of my portfolios for medium to long term positions,
Yeah.
but like to have maybe 10 or 20% of it in doing some of these nip in and out type
Mm.
jobs.
Yeah.
And
No, good.
ultimately, it doesn't matter how we make money, does it? If we
No,
make
no.
money,
Yeah.
as
Hey,
my
I'm not proud. No doubt
no,
about
I
it.
mean, as my mentor says to me, Paul, just do more of whatever works for you. And
Yeah.
so I think, let's be flexible and adapt to
Yeah.
market
Who's
conditions.
your mentor, by the way?
Oh, he remains anonymous.
Oh, does he? You've got one. Oh, I'm impressed.
Yeah, no, he's a great guy. He's supported me, with great wisdom and emotional support and everything over about 25 years. So he's a
Okay,
fantastic friend. So yeah, I'm
good.
very lucky.
He doesn't live in Omaha, does he, with Mr. Buffett?
No,
Anyway,
no, sadly not.
he's not that guy. Now, another area that you've done really well at, and this is a sort of like, I suppose, jumping on the coattails of it, is was gaming realms, because you did really well out of the was it best of the best, and this one is sort of like software for sort of like low value games. It's more bingo, slingo, I think it does, and it does it
Yeah,
for a lot of
Slingo.
titles. Do you want to take us through this one, because you did really well out of BOTB,
Well,
and
I mean, people are going to be getting sick of this, aren't they? They're going to think, "Oh, Paul thinks he's so clever and he's good at everything." It's
no,
I've had,
but if you've
I've got
made good
plenty of
money in
stuff
one
going wrong
section.
as well, Paul.
Yeah, but
Plenty of things go
if you
wrong.
made good money in one area, and the onions in this area, why do you run away from it when you can see a similar opportunity? That's all I would say.
Mm,
That's sort of the broader point. But anyway, yeah.
yeah, I mean, on Gaming Realms, I was late to the party. I didn't spot it. Until quite recently. So I'm not.
Mm,
I'm only slightly up on that one.
yeah.
GMR. It's somebody flagged up to me that the 2022 results were really, really strong, and for some reason, I don't know why. Probably just too busy on other things. It slipped through the net, and I didn't
Mm,
cover it on the in the small cap value report. So belatedly, I had a look at them about a month or 6 weeks ago, and I thought, gosh, this is really good. It's gaming software for Slingo is the main
yeah.
one. It's this strange combination of a slot machine and bingo
Yeah.
above, sort of integrated, and it is
Mm,
really, really popular.
yeah.
It's like, for example, on television the other day, there was a gaming company, I think it was Red 24 or something like
Mm,
that, who had a TV ad on, and they mentioned Slingo within it and
mm,
had a screenshot of it. So, and Gaming Realms is behind the software, and I think it hosts the software as well on its
yeah.
own servers. And then online casinos sort of link into it and pay a royalty
Mm,
based on the amount of customers who play it, and it seems to be just going from strength to
yeah.
strength. So I would say to people, have a look at the figures for Gaming Realms, and the forecasts look eminently achievable,
Mm,
and it's only on a forward PE of about 14 or 15 times,
yeah.
which is very cheap for a company that's generating this amount of organic growth,
Mm,
and it's selling this product globally, and a lot of quite big US gaming groups are licensing it. So I think it looks really good. Yeah.
yeah. Well, I mean, the cash generation's enormous in these gaming companies. So yeah, no, I'm with you.
Yeah. And I think, oh, I'll tell you what I've just remembered what else it was with that. There was some substantial direct buying, well into six figures, from, I think it's the non-exec who was the founder of Sporting Bet.
Yeah. Okay.
And he's buying up, six-figure tranches of Gaming Realms shares. So he knows his stuff, and he's got lots of money. So I think that seems a good person to follow.
Yeah, no, I would agree. Another one in the sort of the gaming sector, Rank Group, which does it's got the physical sort of Grosvenor casinos in the UK. I think it's got about 45% of the casino market in the UK, and then it's got the Mecca bingos, which is
Mm.
more lower value. So it seems to be covering all bases. What's your sort of
Yeah.
latest on this one?
Well, I know very little about it actually, but I thought I'd include one of Graham's stocks
Yeah,
in this. Graham, my colleague at Stockopedia, he covered it fairly recently and said it doesn't look an obviously bargain type share, but it's reporting good progress on cost stabilization and reductions.
yeah,
And as you say, it's got a very big share of the casino market. I think it's Grosvenor Casinos, its
it
brand,
is
isn't it?
Grosvenor. Yeah,
Yeah, yeah, which are nice, nicely invested, pleasant sort of
yeah,
places to go if you go to casino. I mean, I don't go to. I used to be mad on casinos when I was in my 20s, and
mm,
then I tell you, and I was always losing, and you have a couple of big wins, don't you, that get you excited. But it was Evil Knievel, funnily enough, who put me off it once. I used to when I lived in London for a little while, and I invited him out to a casino. I said, "Why don't you come with us? Me and a couple of
Eve.
others go to."
Oh, see, okay. I was going to say it wasn't the guy on his motorbike. This was the chap
No,
who
no, no, the
shopped it.
shares
Okay, yeah.
Evil Knievel. Yeah,
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 somebody
yeah. Simon
Corkill or something.
Simon
Simon Corkill.
Corkwell.
Yeah,
Yeah, and I
Corkwell.
said to him, "Would you like to join us just for a meal and play a bit of roulette and everything at the casino?" And he looked at me and said, "Why on earth would I want to go to a casino?" He said, "The odds are against you, Paul. What the hell are you doing throwing money?" And I thought, bloody hell. that was like an epiphany. I thought, God, he's right.
Yeah,
So I don't think I've ever stepped in a casino since. It's
yeah,
mindless, isn't it? Just
yeah.
throwing money away.
Yeah, albeit if you've got casino licenses, they just can't get them. So it isn't as though they're going to be putting new casinos, sort of like around the UK because it's just
Oh, that's a
impossible to,
good point. Yeah, no. So I
they've got
mean, rank, yes. I mean, obviously, rather than waste my money in a casino, I think it obviously makes more sense to own one, doesn't it?
yeah, yeah,
And the other thing is, they're saying that the high rollers are not coming to London so much, apparently.
yeah,
So Graham, basically, I don't really want to speak for Graham, but I agree with what he wrote about it, which is that this looks nicely set up now for a good recovery as
mm,
just consumer discretionary spend,
yeah.
may improve over the next few years.
Yeah, I get my highs and lows from the stock market. I can't be doing with the sort of like going on blackjack. That's for sure. Not
No, me neither.
nowadays.
Well, with the stock market, we found
Yeah, I know.
the
Yeah,
ultimate form of posh gambling, my
it
friends
is.
call
Yeah,
it. Posh
exactly.
gambling, where the odds are in our favour.
Yeah, just
What could be better?
no, just.
Yeah,
What about
sometimes.
on the market? Because this was a sort of Chris Mill's favourite, and it keeps getting largely sold off. I think on the back of
Yeah,
just sort of like some of their sort of long-term shareholders, the estate agents, just dripping stock into the market, and
that's
it's
right.
actually got a really rock solid balance sheet. It's a
Yeah.
challenger just for right move, isn't it? Small the right move trades about 8 times PE, and it's got cash on the balance sheet.
Yeah, it's great. I mean, it's one of these baby bathwater situations that in a
Mm.
bear market, everyone just, you can't even get anyone to look at the numbers.
Yeah,
I can tell them, look, it's got 10 million cash in the bank, quarter of the market cap. It's profitable. It's got a really good switched on CEO who's, enhancing the product, the
mm,
servicing offerings, and on a tech basis, they're trying to build a suite of sort of tech features which are of benefit to estate agents and so on. Nobody's interested. You can say anything and people
mm.
will not even listen. And it's often situations like that where you can get your biggest percentage gainers, I find,
Yeah,
where
yeah,
everybody's written it off. I think it looks really good, and I wouldn't surprise me if somebody comes along and bids for it on the basis that it's sort of it's trying to develop a tech orientated
yes.
alternative to Rightmove. Well,
Mm,
what if somebody comes along and say, right, let's stick some AI in this,
mm,
and a private equity group or something might just bid for it, throw 100 million at it,
yeah,
and try and if it even becomes the number two portal, it's currently the number three portal.
mm,
If it even becomes the number two portal, it could be worth 10, 20, 30 times the current market cap.
mm.
So, and I don't see a lot of downside risk with it either.
Yeah, I mean, Zoopla could buy the thing, couldn't it?
Yeah,
If they were
yeah,
allowed by the competition authorities, I'm not sure, but assuming they've already allowed Rightmove to have like 60% of the market, then they should allow somebody else to have a bigger chunk. But hey,
yeah. So I mean, I don't. It could be one of these things that just absolutely nothing happens,
mm,
but it's not burning cash. It is profitable, and you got the upside in for free. So yeah, I like it on the
yeah.
market.
What about Wilmington, which does sort of like information services for businesses for in a lot of the
Yes.
regulation side of it and the compliance side of it, and
Yeah. Well.
it seems to be doing pretty well. Plenty of cash, and trading
Yeah.
well.
Yeah. Wilmington just cropped up on one of my small cap reports, and I thought
Mm,
this looks jolly good. Trading well, reasonable valuation, good outlook, sound balance sheet. Yeah. So I just wanted to flag it to the listeners. Just
yeah.
some of them might want to have a look at it. Yeah.
Yeah, no, I've spoken to a few fund managers, and they all sort of, say it's a rock solid business. And
No,
then
that's good.
finally, we've got H&T, which is the pawnbroker in the UK, and that
Yes.
seems to be that. I mean, it's that counter-cyclical play, I guess, and it's sort
Yes.
of like all it's firing on all cylinders in terms of its pawnbroking business, its pledge book, and its jewelry sales, as well as its forex.
Yeah, I mean, I always say to people, look, I don't want to own a pawnbrokers. I
Mm.
wouldn't be comfortable with it. But then I realised actually, if it dropped in price another 20%, I'd probably buy
Yeah, well,
it. So I
it
mean,
trade 7.5 times PE.
yeah, it's so cheap, isn't it? And you get, yeah. I mean, again, I wouldn't particularly feel comfortable getting a dividend from from financially distressed customers. But again, if the dividend yield went up to 12 or 13%, I'd buy it. So I
Yeah,
think the moral argument is BS, basically.
yeah, okay.
I think if it gets cheap enough, we'll all buy anything. But no, I mean, I listened to management webinar recently when I was on I downloaded it, onto the phone and listened on my headphones on a train, and I thought these people sound really switched on.
Mm.
They've got various elements to it, as you say. There's the pawnbroking and the foreign exchange and various other things. Yeah, I just think it looks a terrific track record. It's the market leader. I think was it Albemarle and Bond went under,
Yes.
didn't they?
Yeah.
So H&T is the survivor really, and it's got really, really good balance sheet.
Mm.
Not much borrowings at all. Yeah, I think have a look. If for value investors, definitely have a look at it. I don't
Yeah.
hold personally, but
Yeah.
it does seem to be in a downtrend share price wise. I
Mm.
don't know why.
Mm.
But it's on my watch list anyway. I
Yeah.
might pick some up if it sort of starts forming a bit of a base. I don't know.
Brilliant. Okay, well, fantastic insights, and thanks for your time again, Paul. If anybody wants to sort of like sign up to your the subscription service on Stockopedia, how best to do that?
Oh, well, just go to stockopedia.com, and
Yeah. Okay.
there are free trials, 2-week trials there, and obviously there's a wealth of stuff on the site. My articles are just part of the editorial on there,
Yeah.
and then my podcasts, if I can just quickly plug those as
Yeah.
well. They're on Apple and Google and Spotify and Audiobook and everything. So all you do is search for Paul Scott Small
Yeah.
Caps, and it'll come up. I do a weekend every weekend. I just do a just a 40-50 minute summary of all the news and trading updates each week in the
Brilliant.
small, and I love doing them. They're great fun.
Yeah, no,
So
I would highlight to investors. I regularly listen to Paul's, and I find them fascinating. So yeah, they're really worth tuning into, no doubt about it. In fact, as I say, I'm pretty sure it must have helped the share price of Plexus this morning if it's up 25%.
Well, I know. I mean, this is the problem. Do you mention something that's an absolute nano cap, in that people, even if only a handful of people start buying it, it will affect the price, unfortunately. But there's nothing I can do about that.
No,
I mean, all I would say is, whenever I talk about shares and I say I own it, I never ever sell shortly afterwards.
Yes. Yeah.
I think that is crossing a line. I mean,
Yeah.
some people they slip up at some point. Some of the Twitter type people, they'll or you're having lunch with a friend and you loved a particular stock and you say, oh, how about so and so? And he says, oh no, I sold that one ages ago. Oh, great. Well, thanks for telling me.
Yeah, I know.
So with my stuff, if I'm enthusiastic about what you see is what you get. If I'm enthusiastic about a stock, that's because I own it and I'm expecting it to go up a lot. So that's where I am with Plexus. I am not going to touch that one. As I say, I bought 2% of the company. I'm just going to run with it, and we'll see what happens.
Yeah, and that's one of the reasons why you've done so well. Your integrity comes through in your stock picking in terms of you're looking longer term.
Thanks, Paul.
So, and that's really important. People are the fly-by-night cowboys. They don't long term. They just they get blown out because it just doesn't work. They're just looking for a hit.
They can't remember what they've said and they contradict themselves. So it's very easy to spot that type, really.
But also these people effectively choose stocks where they feel as though they can get a pop on the shares.
Oh yeah.
Whereas you choose and I choose stocks whereby we feel there's a good long-term investment story behind it, and therefore the quality of the selection is likely to be higher than if you're going for a short-term, effectively ramp and pump and dump in it.
Yeah, no, there is a lot of that. I mean, I don't generally even look at that end of the market. I mean, it's very unusual for me to go as low as the market cap on Plexus, but I just think there could be an opportunity there. We don't know. We'll have to see.
Yeah. No, I can't get volume, so that's an area that I can't play in anymore. Anyway, thanks again, Paul, and look forward in touching base in about 3 months' time.
Yeah, great. Thanks, Paul. Really enjoyed it.
Thanks.
Bye for now.